Hello, fellow risk takers. This is your worst podcast host, Andrew Stotz from A Stotz Academy, and I'm here today with Larry Swedroe, continuing our discussion. Larry's got 3 decades as head of research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Larry is unique because he understands the academic research world as well as the practical world of investing. Today, we will discuss a chapter from his book, Enrich Your Future, The Keys to Successful Investing. And the chapter is number 5, Great Companies Do Not Make High Return Investments. Larry, take it away.
Yeah, this is kind of an anomaly for people have a hard time understanding because they think the whole idea of investing is to identify a great company and therefore you would get great returns. But if you understand finance, that really doesn't make any sense. And the first basic rule that we've discussed about, Andrew, is that something that you know is only information. It's not value-added information unless the market doesn't know it, because that information is already embedded in the price through the trading actions of all of the marketplace investors. So here's a good way, I think, to think about the problem. Let's do a little exchange here. There are 2 big retailers in the United States, or 2 of them. One of them is Walmart. Everyone, I think, would consider that to be a great company. And let's say it was trading at a market capitalization of 20 billion, okay? And let's say there's this other company called Kohl's, which is also a department store. It's a company, it's not done great, and it was also trading at a market valuation of 20 billion, even though it has much less earnings, a much weaker balance sheet, doesn't have, all the technology that Walmart has in place, all the management. You can go through every kind of item you could think about, and when comparing the 2, everyone would likely agree Walmart is better. Could that world exist then where both companies were trading at 20 billion?
Doesn't seem like it could exist.
Right. It's not logical. So let's look at a more logical example. Let's say Walmart was trading at a 500 billion valuation and Kohl's was trading at a $5 billion valuation. So Walmart is trading at 100 times the value because it's a much better company, has much better earnings, stronger balance sheet, all those things we talked about. Now, Andrew Stotz is a pretty smart finance guy, and he says, this Walmart's a great company. It's trading at 500 billion. Let me make an estimate of their future earnings. I can even do that by looking at analysts' forecasts of earnings, take a consensus number, and if I have to pay a market cap of 500 billion, I run the numbers and I get an expected return of 10%. Now you take Kohl's with a market cap of 5 billion, much lower earnings, of course, but when you run the numbers and go through that same exercise, because the valuation is lower, even though the earnings are lower, you come up coincidentally with the exact same 10% expected return. Now we know expected returns are just that. They're not guarantees. You might think of them as the mean of a wide potential dispersion of potential outcomes, okay? So if you had that same expected return, which company do you think you should invest in?
Well, it seems like Walmart should be growing faster, bigger, stronger, more profitable.
Well, that's true, but that's already in your numbers. In your numerator there, which is your expected earnings, that's there. Then you have a denominator as the discount rate you use to discount those earnings. And you came up when you had that as higher expected. Let's say we thought Walmart earnings would grow 10% and Kohl would grow 2%. And when you ran the numbers, coincidentally, they came up with the same expected 10% expected return. So you have to make a decision now. Which company should you buy?
So I think most people are going to say, well, I'm going to buy Walmart because I can buy it at 10 times and it's a higher quality company.
Not 10 times, it's the same
Like,
10%
10,
expected return.
10% expected return. I would think that I should get a higher return from Walmart. Maybe
But
that's
the market knows that. It's got that, it's built it. So you end up with the same 10% expected return. So help me out here, Andrew. I'm trying to figure out which stock I should buy.
well, in that case, if everything is factored in and they both have a 10% return,
Expected
return. So the market has factored in the levels of growth, the levels of profitability, and all their expectations of risk and all of that, then they should be equal.
Nope.
Okay.
All right. You should definitely have a preference because in that potential dispersion of returns, you're looking at it. We have to discount the future earnings growth. And I think you would agree because Walmart is a much better company with a stronger balance sheet and all these other advantages. Which is the less risky investment?
Should be Walmart.
Well, if you get the same expected return of 10%, would you buy the less risky Walmart and get an expected 10? Or would you buy Kohl's, which maybe goes bankrupt, or maybe they bring in a new CEO and it turns around and they grow much faster than the market thinks? So you have to decide, if I got the same expected 10% return, I want to buy the safer company.
Right.
So that world should not exist. Walmart's price has to be even higher to make up for or to get me interested to buy Kohl's instead of Walmart. So investors would come in and sell Kohl's to buy Walmart, driving Walmart's price up, but the earnings are the same. Now maybe I get a 9% expected return or 8 or some other number, and Kohl's price goes down until the risk adjusted expected returns are the same. And maybe it's 12% expected return for Kohl's versus 8 for Walmart. And that discount of 4% in the expected return is enough to incentivize me to buy Kohl, because now the risk adjusted expected returns are the same. It's the way to think about this as a simple analogy. If you could buy the debt of Walmart, let's say it's issued corporate bonds for 20 years. Well, Walmart's bonds might be rated A or AA, and Kohl's might be rated BBB or C. The yields are not going to be the same, right?
Yep.
Kohl's will have a higher yield. So that must be because it's riskier. Well, then the same thing must be true of the stocks, because stocks are riskier even than bonds. So the discount rate you're going to use on Walmart has to be lower than the discount rate. Now, let's say the expected return was 12% for Kohl's, a value company trading at a low PE multiple because it's riskier, and the discount rate was 8% for Walmart because it's a safer growth company. Which is a better investment?
Now I'm not sure. I'm not exactly sure. Tell me, Larry.
The answer is neither. They both have the same risk-adjusted returns.
Right.
Let's say we think Kohl's is 50% riskier, and so it's got a 50% higher expected return, 12 versus 8. If the market thought the risk-adjusted return of Kohl's was better, well, then the smart guys at hedge funds and Renaissance would selling Kohl's to buy Walmart, right? Or vice versa. And then the market would move until you got an equilibrium in risk-adjusted returns. So if you believe that the markets are efficient, which we discussed. It's not perfectly efficient, but the odds of you beating the market are so low, you should assume it's efficient enough, right, that you shouldn't try. Well, then all risk assets, when you adjust for the risks of those assets, should have very similar risk-adjusted return. So the right answer is don't engage in individual security selection. Because you can diversify and get the same risk-adjusted returns, but with a much narrower dispersion of potential outcomes. You own the S&P 500, you have a bell curve that looks like this. You own one stock, the standard deviation is probably twice that of the market. So you're twice as much risk for the same average expected return for any individual stock.
So when someone says it's cheap for a reason, do they mean that the reason is because it's cheap because it's incorporating the higher level of risk?
Higher level of risk, higher level of uncertainty, whatever it might be facing greater competition, and it's because its product is more commodity-like. It could be have a higher leverage from a financial perspective. It might have more operating leverage, means it's more susceptible to recessions because they have high fixed costs and they can't lay people off or shut factories down, all those things. So that's how the market operates. It incorporates everything knowable about a stock, putting it into that discount rate. And the discount rate is the risk premium it's the risk-free rate, which is T-bills, plus a risk premium, that's your denominator, and the numerator is your expected earnings. So it doesn't matter, it's completely irrelevant what the earnings number is. In terms of your expected return is always the discount rate. The numerator drives the present value or the current price. So with the same discount rate, if you have higher earnings, all you do is you have a higher price. You don't get higher expected returns because you have higher earnings. That's set by the discount rate.
And if you look at the overall market, and let's say the average return of the overall market has been 10% per year, let's say, take a number like that, and then you say to yourself, okay, I want to understand, how do I risk adjust that return? How do you do that at market level?
Yeah, so what you could do is look historically, and let's say T-bills have averaged 3%. And so if the market got 10, at least on a compound basis, you've got a 7% risk premium for taking the risk of 1973-4 when stocks dropped 50%, the risk of 2000 to through 2002 when they dropped 50%, the risk of 2008, etc. That's the risk premium you can earn for accepting that big fat left-tailed skewness risk. The stocks basically never go up 50% in a year, but they do go down 50% sometimes in a year.
And so when I see that premium, let's say going from 7% to, let's just say, 3%.
Yep.
So it's a big difference. And I think you talked a little bit about the idea of kind of trying to understand a little bit about when you're at peaks and when you're at bottoms. What would I read from that?
Yeah, so what happens is when the discount rate is going down, that means the PE ratio, price to earnings ratio, is going up. So a simple way to think about it is to use what's called the Cape 10, okay, which looks at cyclically adjusted earnings over a 10-year period to kind of smooth out the highs and lows, because we want to look at longer term data, okay? So it turns out that over long periods of time, worthless over the next 1 or 2 years, but if you invert the PE ratio, you get an earnings yield. That's the cyclically adjusted PE ratio. So historically, stocks have averaged a PE of about 16. Now invert that for me, Andrew. And what yield or earnings yield do you come up with?
16. What is that?
16 into 100, about 7, right?
Yeah, I was gonna say, okay.
Gee, coincidence. We got a 7% risk premium.
Okay.
All right, now what happens when the PE goes to 20? Well, now what's the risk premium?
Now
It's 5%.
Right.
Well, it turns out that on average, but when you get euphoria and the PEs like in 99 go to 40, well, now your earnings yield is 2.5%, or maybe it even went to 50. And the NASDAQ stocks, they were 100. Now you have much lower expected returns. And inversely, okay, when the Cape 10 is low, the earnings yield is low, like in the middle or depths of recessions. Okay, in 2009, maybe the PE dropped to 8 or something like that. Now you got a 12.5% real return expected to stocks, okay, or a risk premium roughly equal to about that. So now that doesn't mean that stocks are a good buy when the earnings yield is low, and stocks are a good sell when the earnings yield is high. And there's almost no correlation over the next 12 months. Over the next 10 years, even, the correlation is about 40%. So that's telling you it's a lot, but it still means there are wide potential dispersions of outcome. So when the PE is, say, 20, the median is 5, but there's still a good chance you may get a 6 or 7 or 8 or even a 10, okay, percent return. But there's also a chance you're going to get 4 or 3 or 2 or -2. And as the yield goes up, all that curve does is it shifts one way or the other. So a higher earnings yield means the curve is shifted to the right, meaning your median expected return is now higher. And the reverse is true when the earnings yield goes down. Now everything, the mean is low, but you can still get a 6 or 7% real return. Like in 98, the Cape 10 was very high, but 99, the market went up 28%. Now, 2001 and 2 were not so pretty. So you can't really use it to time it. And what I tell people is this: what you have to understand is you need to build a plan that incorporates the fact that when earnings yields are low, you need to expect low returns and that adjust your asset allocation accordingly to make sure you have a good chance of achieving your goals when that's the case. Doesn't mean you necessarily should change your asset allocation per se. You may need to decide, well, stock returns are going to be lower. I need to save more now, or I need to lower my goal or adjust that because I don't want to take more risk. Alternative, you could say, I really want to retire at 65. I'm going to have to put more money into stocks. At the same time, I'm recognizing that the expected return is now lower. And you have to incorporate the same thing with bonds. When bond yields are higher, you don't need to take as much equity risk if real yields are high, because you get a higher expected return from the bonds, so you need less from your equities. So that's how you want to use this, is mostly in that way, is to build a plan and decide how much you need to save, invest, how much should be stocks and bonds. The last thing I would say is, don't try to time this, or I'll emphasize that. The only thing I will say is this: if you're going to sin, and by that I mean try to time the market, one, do it only at extremes. So PEs of 20, 22, 3, I probably wouldn't do anything except make sure your plan incorporates that now lower expected return. But at 40 PEs, boy, that's getting tempting to say, especially if tips yields, which are risk-free, are say 3%, so I'm getting a higher real return expected from tips than stocks, then I might say, I might take a bigger position. All right, let's cut some equity risk to do that. That's what I did basically in 98. I, got out of the asset classes that were trading at very high PEs. I just moved to an all value portfolio because value stocks were trading at PEs of 12, not 40.
And there's two questions I want to ask before we wrap up. The first one is, what's interesting about talking to you is that most people in the market talk about PE and you talk about expected return. And I'm just curious, like, what is the source of that? Is that because you think about it differently, or is it coming from an academic side, or, it's interesting.
Yeah, well, you talk about PE because that's the common language, but you have to understand that a higher PE doesn't mean a higher expected return, right? It may mean that you're paying a high price for high expected growth and safety because the company is a really strong company, right? So you can't think of that PE and high. Now, high PE doesn't mean it's a bad investment necessarily, right?
Yep. And
in my view, is the market's efficient, and I think all risky assets have similar risk-adjusted returns until we get to these bubbles, which really extreme valuations.
And the last question is, when we talk about risk-adjusted return, we talked about like Kohl's and Walmart and looking at stocks and things like that. A lot of people, when they talk about risk, they oftentimes refer to volatility, let's say a standard deviation or something like that. When you're talking about risk, are you talking about that, or are you talking about something different?
Well, risk is one measure of, volatility is one measure of risk, but it's not the only measure of risk, okay? And to use technical terms, we have skewness and kurtosis, which are the tails. So you could think of a lottery ticket, right? It's left skewed, meaning most of the returns are to the left of the mean, right? 95% of the lottery tickets lose money, but it's got a big fat right tail, right? And that's where everyone likes to, or many people like to buy lottery tickets, right? So that's a problem. People like the opportunity to hit that home run, right? So you have to think of volatility plus these, are you willing to accept that stocks are left skewed? The bad returns are larger than the good returns, right? We can go down 40, 50%, but you don't tend to see that, right? But the reason you get high stock returns is you have to live with that really bad left tail risk that correlates with your labor capital because you could get laid off.
Is what
right?
You're saying.
So what we have to think of there, and then there's even another risk, which we've talked about in some cases called liquidity. If you need to get assets and turn it into cash quickly, say you own a rubber plantation in Indonesia, not very liquid. I can't pick up the phone and say, sell my shares, and next day I get the cash, or 2 days later, I get the cash. You might be spending a year negotiating, right? So illiquidity is another risk, right? In credit risk, duration risk. These are all things that have to be considered. And that's what the market does in its infinite wisdom, is it is taking the collective wisdom of the market, incorporating it. So the only time you really should be taking, positions, if you will, and betting against the market is because you have a different risk profile than the market. So I'll give one simple example. Okay. I'm now 72 years old. I have to take out of my IRA accounts what's called a required minimum distribution, which is about 5% of my assets. Okay. Now, I can own illiquid assets, assets that allow you to take out 5% a quarter at a minimum, but that may be the most you may be able to get out. You may be aware, your listeners may be familiar with the travails of Blackstone and now S-REIT, Starwood's REIT, and KKR's REIT, where they got gated and they wouldn't distribute out more than 2% in any month and 5% in a quarter. So
When you
that's a
say
risk.
they got gated, you mean the
Investors got gated.
Yep. Okay.
So if you had $1 million investment in Blackstone's REIT, you could get out 20 grand a month and for 2 months, and the third month only 10. Now you're still, if you had $1 million, got 950,000 and you want out, but you can't get it. So that's an illiquid asset. So it's going to have a premium.
Hmm.
And I don't care because I don't need more than 5%. That's all I'm required to take out, and I have other assets. So I can get at least 20% a year. So I can say, like the Yale Endowment and Harvard and others who are spending only 5 or 6% a year, maybe, of their endowment, I can invest in a lot of illiquid assets, earn that premium, because for me, that's not as risky as it is for the average investor. So I should overweight assets that for me are less risky. So I'll give you another example. If you're a construction worker, you're highly susceptible to the economic cycle risk. You probably shouldn't own deep value stocks that are very cyclical, because they're going to have low prices in the middle of a recession, and you get laid off and you've got to sell stocks to put food on the table. So you're selling at the worst possible time. But I didn't have that risk, so I could have more exposure. So I would own more value stocks, not because I think value stocks are higher risk adjusted returns. I think the higher expected returns, but not once you adjust for those extra risks. But I don't have that risk, so I can overweight that risk. So that's the way investors can build portfolios. They should favor assets that are risky to the average person or in aggregate, but not so risky to them.
So that's a great discussion on this chapter of great companies do not make high return investments. And I'm looking forward to the discussion of chapter 6, which is market efficiency and the case of Pete Rose. And for those people that don't know Pete Rose, he was a famous baseball player and later a coach, and got involved himself in a little bit of a scandal.
Right, betting on his own teams and stuff. And we'll talk about his track record in betting when he had inside information of betting on his own teams.
Can't wait. Well, Larry, I want to thank you for another great discussion about creating, growing, and protecting wealth. And I'm looking forward to that next chapter. And for listeners out there who want to keep up with all that Larry's doing, just find him on Twitter at Larry Swedroe or on LinkedIn. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.